This is not the earnings. This is not the uh, this is not per se the performance of the stock price itself, but rather this is the PE, forward PE. Which is what I was mentioning just now. The PE levels are not that high. It's high, right? But if you compare like even the NVIDIA or that, right? So this is based on their data. So this is through the FinVis website. So they pull the data based on what they can extract off the internet and the company's earnings results and the declarations. But in general, it just shows that the PE for forward PE is not as lofty or not as impossible as what it seems. So some people say the US market have been rallying so high for this whole year. Is it time for a very strong pullback or whichever? So the bottom line is that if the earnings can support this stock movement, there's no reason why it has to really correct so much further down. You compare that to the Asian market, like Hong Kong, China, why there isn't that same movement is that the earnings is not showing for the Hong Kong and Chinese market, right? The only market that is actually fighting in terms of the earnings recovery and rebound and everything will be more like Japan and some parts in India, but India not really as accessible for most of the market or for most of the investors per se. So generally, you're still looking at US, right? So this is the gist. Okay, so looking at the performance of the stock market, that's one thing, right? So now we look at what is the economical factors that might be affecting it. So we do have some geopolitical tensions. So two main ones that you might be aware of, right? So first one is the Ukraine and Russia situation. So I think some of us might, if you are following it, right, so you might be surprised that why the Ukraine actually did a sort of a counter attack where they did encroach into the Russia's territory, right? So basically, right now, both of them are still reporting their own respective gains on the battlefield. So the Russia is nearing towards one of the main cities of Ukraine. Ukraine also made entrance into the Russia side to do sort of like a deterrence zone where they can reduce the attacks on their mainland itself. Okay, so one of the key new developments for this part of the conflict is that for Russia, they actually near one of the city called Provosk. So my pronunciation might not be correct, but basically this city is an important city to Ukraine, where it's the main transport zone, not only for the supplies, but also means that if Russia can control that city, then Russia have more angles or more path that they can enter to Ukraine. So there's more influence of the whole conflict per se. Okay. So then next we have the Gaza peace talks. So the other is also ongoing, has always been slow. So there's always a lot of conflict in between what should be done, whether or not there should be more peace efforts and everything. But the main idea is that for this both conflict is an ongoing issue for some time, and there is no real key developments that can actually adjust the market. So these two more likely than not will continue even for the remaining of the last quarter, and very likely for especially for the Gaza peace talks, right? So from what the US side is indicating, there might not be a very strong or very significant development until after the US presidential election, right? So where whoever win might influence this issue a bit more based on their own respective policies or their direction they want to do. Okay. So I mentioned, so the US election is actually upcoming, right? So start of the year, we keep saying it will be for this year, right? It's still some time to go. Now we're already at the near end of August. It's no longer some time to go. It's really just the next few weeks per se, right? Just early November will be the date. So currently, right now, based on opinion polls, right? Of course, there's a few opinion polls and a few different results, but in general, they are saying that Harris actually now, in general, lead the polls, right? So technically, she also just did one of her speech on the Thursday evening in US time on some description of what she want to do for her policies and direction and everything. So the two things I can conclude from what she's saying, that she's trying to do some domestic wise, she's trying to boost housing supply, all right, trying to reduce certain price manipulation, so-called by the groceries, I mean from the their commodities or their consumer all the consumer products per se. All right. Then next you have they also propose raising corporate tax. So this is her angle, right? So these are two main one that will affect the economy, right? She also wants to call for a strengthening of the bank rules, whereas for Trump, likelihood he want to weaken the bank regulations, especially for the big banks. So this one will actually affect a lot of the financial counters. And if you're invested into any of them, definitely be interested to know or to be aware. So why we list it out like that is because sometimes if you are already invested, you're not going to say, hey, I'm going to sell and then I'm just going to wait for the result before I reinvest. Right? Because you might miss the opportunity of the entry price that you want. But knowing this risk involved can allow you to do certain decision like you want to do any hedging. Are you going to do any preparation like maybe you're looking at even price points by putting some price some alerts that you want to put in the price levels, or you want to put certain hedging through the index or through hedging through counter itself. Okay, so later I'll talk more about the hedging part. Next, we have the currency issue. So this is the newest screenshot I grabbed yesterday, right? Based on the CME, the Fed Watch, the tool. So this is the expectation, right? So expectation for September 18, right? Generally, it means that as of yesterday at least, right? They 100% expect rate cut. It is between 1 or 2 rate cut. So one is at 75%, two is at 24.5%. This is as of yesterday afternoon, before Powell's speech. I believe this one have moved already. After yesterday, the speech after 10 plus PM. We can see again on Monday, right? But likelihood is that the 100% rate cut part should not change. It's just between 1 and 2. This is what I expect as well. Second thing, by November 7, all right, is at least 2 rate cut. Because you see these 3 bar chart, even the most right hand side is at 2 rate cut. So it's 2, 3, or 4 rate cuts by November. This is what this chart is trying to say. They're not even expecting only 1 rate cut. So by November, they expect at least 50 basis point cut the US, the Fed interest rate itself. Okay, so this I can see here. And then another thing, by December 18, as of yesterday afternoon, they expect at least 75 basis point cut. So that's 3 rate cuts. So at least meaning that the most right hand side, the highest level they expect it to be at the end of the 18 December meeting is at 450 to 475, which is 3 rate cut from now. So this is the expectation. And you see the median or the most highest expected level, that will be at 4 rate cuts. That is for this particular how this is trying to show. Okay, so this is what we are in right now. So this might be of interest to you, especially if you are trading in the US treasuries, financials, REITs, property market, and everything. So as long as you're in counters that are directly influenced by interest rates, you will be interested to follow. So you can actually follow this data itself through the CME Fed tool. If you are not sure, you can Google CME Fed Watch. Okay, they will actually the link will actually bring you to this tool itself. Okay. Okay, so basically that was interest rate movement, right? So this is some technicals for you to see per se. So this is the US Nasdaq index, right? Nasdaq index. So you can see this is actually drawn quite a bit further back. I think until 2019-18 or so, left hand side. So there is a very strong rally since then, even after COVID and everything. So you see November, no, March 2020 was post the dip of the COVID peak itself, right? There is a very strong rally all the way in another rally round from December 2022. So there's 2 main rally rounds, right? So, and then there is that correction down from 21 November to December 22. So what I did for this particular chart is I used the low from 23rd March 2022 to match to the November 2021 high. And I draw it down to December 2022 to fit a Fibonacci projection. If, let's say, the market is on the uptrend, how far up will it go? And you can see that actually, out of this itself, right, you can see that it actually matches just nice the high part from the December 2022 to the recent high in July matches the same level, which is around 20650, matches the same level as the first rally, the height. The size is about the same. And that's why the level actually does match. And right now, of course, there's a correction back down off that level. All right. So right now you are still at around 19,500 or so. This is as of Thursday, end of Thursday. Okay. But then you see that this is just a zone. So this is the zone I feel is important. 18,515 to 2650. This is the longer term itself. So let's zoom in a bit more. So you zoom in a bit more, this is a bit more zoomed in, right? So you're a bit nearer to within the dates that you're seeing. So same thing, all right? So I'm actually using the same way I project the Fibonacci level, but instead of using the longer term 202, 2021 and 22 numbers, I'm just drawing off the low as of the, I think, October 2023 and high as of the July, and then drawing back down to the recent low in August 5th. Right, and you project upwards, and then you see this is the levels, right? So this is just levels that the Fibonacci suggests might be of a significant level. And if you actually see how it matches off to the different way it moves to the chart, it actually matches quite well to some of the key points level. So one of them you can see is the 19022, right? The red color one, right? So it bounced off a bit, but it was actually using this of that as a, it was quite good as a resistance level previously. And then now it's back up, big above again during the rally, but it's currently have adjusted back down from the 1993 level, which is the next Fibonacci level. Okay, so if we're seeing is like personally, I'm bullish on the Nvidia's result and also the tech results upcoming. If you're bullish, similar like me, you will seeing an uptrend. Then likelihood it will test that 1993 level. And then going back up to the next level, then that will be the 20,777 level. All right. Okay, so this is even though it seems like the chart very small only, the gap, but actually this is around 3 to 4% each of the segments. Right. So if you're used to Singapore market, normally 1-2%, you might not be used to this movement. But this 2-3% of the main index can happen overnight. This is how US is. It's not like Singapore. Singapore moved maybe 1% over the whole week, or maybe 2%. But US market can move in one day 2-3% for the index itself, for the whole market. So this is also one thing to note. And one more important information I want to share with you is that currently it's already still at the near 50-day moving average level. So if you see also the blue line, right? So during the initial rally, they see on the left-hand side, right? From end of last year to start of this year, it has mainly stayed above the 20 and 50-day moving average. It has broken down recently, right? Around, I think, the April adjustment, the correction period. But thereafter, you have moved back up and stayed above the main chart itself. Have stayed above 20 and 50-day moving average also for the second rally. You will see that. So right now, it has broken down again for the second time. So if you compare that same movement, you will see this recent rebound back up as a similar idea of what happening during the April-May period. The rebound back up. If it stays above both moving average, you might be seeing the third uptrend for a short-term line. Right? So this is just a pattern that you can actually see. Of course, it might not happen. There might be a bad news. Nvidia might not have good results. There might be other counters that is announcing not as good results, or there might be certain economic data that is negative. You'll call a real pullback or correction. But in general, right now, I'm still quite bullish because not only technicals, but the fundamental wise, all point towards a more positive direction or soft landing for the economy, which is beneficial for the tech stocks. And with the rate cuts itself, is generally have typically been positive for the tech stock itself for rate cuts. Okay, so this is the next one. So you want an even broader market, S&P. All right, S&P. S&P, and I'll do a long one. Let's go straight to the short zoom in one. Now it's time. So this is the more short-term movement for S&P 500 index itself. So you can see right now, the one I'm doing for this is, just now I was pricing in for optimism bullish, right? So up, then correction down, and then project upwards. Now I'm doing the opposite. I'm using the high of the April 2024 to the low in April, and I project up to the July high to see if I project downwards, what is the downside risk to the main market. Versus now was optimism. Now let's see what happens if I prepare or see my risk levels of the downside itself. So based on that itself, the downside projection, you can see also it fits quite well, right? But this is the main zone. Main zone is from the high in July 2024 to the gray line here at 5350 also. But you see it touches the blue line here. So that is the extended line from the Fibonacci. The first extended line, 161 level also. And it actually fits as one of the supports, right? But let's ignore the support first. Let's look back up on top. So these are the levels where you can see it actually was fluctuating between the red line, which was acting as the resistance or support at the point of time, right? So level of significance 5595, that's the one, red color one. All right. So the zone you're looking at is between 5550 to 5670. It is the current zone to be seeing within currently. And if we cannot stay within 5595 to 5550, which means that there is a pullback below that, then likelihood there might be a general correction back down to at least the gray line level. At least the gray line level. And that's around 5354. Right. So that's what I think. Right. So if you believe that right now the market has already been rebounding so much more, then there's some rate cuts now coming in, there's some earnings results coming in, might not be all positive, or might be good results, but might not meet the expectations. They might not meet the very high expectations that the US market have. In the correction, you might see that level of correction, and this zone is around 4%. In case you are wondering how much is it in percentage, it's around 4% correction that could happen, which is very likely also, based on the way the US market always move. So if you ask me on the chances of a correction before a rally, then I'll say yes, potentially. So between 2 to 4% before the rally, but generally I'm still bullish for the long term, for at least to end of the year. Okay, so this is another one. So since I'm bullish, right, so I want to show you my point of view. If you're bullish, same thing. I just draw in a different manner. All right. So if I'm bullish per se, you can see right now the levels to me important will be 5560, which is same as just now, around the 5595 level, right? And then to 5679, and then the uptrend upwards projection I'm looking at for resistance is at 5832, 550 level, and that is also the upwards difference from now is around a 6% difference. Okay, so this is my personal view. So I feel that if there's no need for a correction, if it does go straight back up, bouncing off maybe a slight correction of the levels near the moving average, that will be around the 548, 5500 level. Okay, so that is my personal take that if there is correction, it's going to be a minor one, and generally the uptrend should stay intact based on how it's currently moving. And based on upcoming news, there is not much negative news. With the Friday Fed announcement on the Jackson Hole Symposium, but generally it seems all quite rosy for now, until there is specific results from the earning companies as well as the Fed meeting. So the only one from now to Fed meeting in September that will affect or to derail this uptrend will be first the Nvidia's earning, second is the subsequent earning results by the other big companies. Okay. Okay, so this one also might be of significance to you, right? So if you are not say just a trader, even if you're just traveling, you can see that currently recently the USD and Sing dollar have moved a lot. Or not only even USD Sing dollar, even the Sing dollar yen, US yen have moved a lot. Right. So of course the yen have dropped in comparison to us, right? So from the high of 120 now back to below 110. Right now, I think as a recent, it should be back up now 111 level, 112 level. But in general, that reflects that rapid decline of the US market in the USD strength. So this was when there was a lot more confirmation or a lot more expectations that the economical data supports the rate cut direction. So you can see the point of the big drop before that. I drew a vertical line. That's 19th of July, right? The first deep level. If you see the further deep down, you will see all the way to the August 5th correction period, same thing. There's also the big decline was all at those point of time. Okay, so I'm not saying that it's just purely for exchange rate, but for what's significance to us is that if you actually follow some of the news that they report why the USD have fallen so much. Okay, so let's take this idea first. I try to explain in a simplistic manner is that when USD was giving you very high interest rates, right? You want to deposit in USD over Sing, right? Because USD giving you maybe 5%, Singapore giving around 3%. But if you take a loan in Sing dollar, you charge you around 4%. Okay? Let's say you only pay 4% interest to take a loan in Sing. But USD is giving you risk-free rate, risk-free of 5%. So you will take the loan and I'll put it to USD and then I'll invest in USD for risk-free or even with a higher risk for the return. But when these things start collapsing, meaning the rates start reversing, right? There's no more stable rates per se in exchange rate. You will start earning in interest rate but start losing in net value because of the exchange rate. So what you do as you see this happening, you will sell the USD. Take the money back out, convert by the same and return. Okay. This is in Sing dollar equivalent example. But this is not what happened in the main market. The main market, this is happening in between US and yen, US and Japan. And that's why you see the very big spike and up and down for US yen level. But in general, what it means also is that when there's a selling off pressure, that caused that early August correction in the US market. Because you need to sell, right? You need to sell your assets, you need to sell the investments to get the money out and convert it back to whichever currency you need to return. And that's why there's both selling pressure in the stock market as well as in the currency market. So that's why you can see this correction of the USD itself. So of course, I didn't put the US dollar one, but if you want to see the US dollar index itself, with just the US dollar strength across all the currency, you can also see the same decline happening as well. Okay. So now we know this information, right? So these are just information per se. So what can I advise or what can I share with you to help you itself in an investing journey? Okay. So currently I group to certain categories. So first one we have is no matter what we say inflation dropping, interest rate gonna cut or whichever, inflation is currently still above the Fed target. Okay. So no matter what the Fed do to try to so-called support or to adjust to support the weakening market, right? The Fed also still acknowledges that it is still above their target. Right? The rate cut is just that they don't want to maintain rates so high that it causes a recession in the US economy. But it doesn't mean that inflation is already back in control based on the Fed's direction. Okay. And if we see actually on the bottom part, this is the chart, right? The blue line, solid line, and the dotted line. The dotted line is the core inflation. And core inflation right now, if you see through the main chart, has been higher than the solid line since 2023. And what does dotted line mean? Core inflation in US, they remove food and energy. They remove food and energy, meaning that the core inflation coming in above generally influenced by what thing? By housing for the US market. And that's one of the key factors. And that's why you see in Harry's proposal for direction for the economy, she targeted on the housing itself. Right? Because housing issue is going to be ongoing for US, not only for mortgage, but also on the housing ability, affordability per se. So in general, US is not yet having full control. And even within the food itself, there is segments that is not doing well within the US the numbers itself. So it's not already. You don't see the main headline number as it is coming down. It's already been lower and lower and lower. Means the Fed will cut rate and then everything will turn for the better. Doesn't mean like that for the US market because there's a lot of segments within the inflation that will affect. And one of the key reasons for the decline was actually on the energy costs, which is why the inflation is coming back down. But if the inflation of the energy itself might still pick up if anything happens within the conflict, the two conflicts, right? So with Russia, we also have the Gaza Strip area, the Middle East issue. So if anything happens or any escalations happens, or even the OPEC coming to do certain things, we might see inflation coming back in from the energy sector, which also will impact the US inflation numbers. Okay, so it's still above the Fed target of 2%, right? So there's still sticky inflation. I mentioned housing, right? So there is certain parts that's showing deflation in the US, all right? So there is that issue that they need to adjust for. So deflation is not good in any economy, okay? So right now the issue is that we see inflation coming down as good because we correlate that with interest rate cut. That's our correlation as an outsider of the world. But if you're staying in the US, it's going to mean that you won't have a lot of issues. Right? Deflation doesn't mean that it's better just because it's cheaper to afford. But it means that your economy is stagnating. Your pay is not increasing as much as the inflation area segments, but the deflation is not helping you as much as well for certain areas. So net-wise, you're going to be seeing that your cost of living is still going up. Right? Cost of living is still going up as a net value if you are staying in the US. All right. So that is the issue. And one of the key reasons also is on the housing cost itself. Okay. So if you are going to look at just purely this high inflation environment and how you would trade within this issue, right now we really see it's coming back down. We're saying inflation coming back down. But generally, high inflation is good for sectors for commodities. If you're in commodities trading, you're trading into oil, trading into gold, you're trading into like grains or coffee beans and like that, it's going to be good for you. In high inflation in general. Right. Another one is that why you look at utilities, real estate, and consumer discretionary is that if inflation starts coming back down, right, it really get into control, right, or it's still high but it's getting under control for the US Fed, then when they cut rates, the correlated sectors that affect is discounters, utility and real estate because they give high dividend. For consumer discretionary and consumer staples is because when inflation is a bit lower, it becomes more affordable for consumers to actually spend on these items, right? So, but then that one also depends on the retail confidence level as well. So the recommended trading opportunities, so-called, right, is mainly for purely high inflation. I'll look at mainly just the gold and oil, as well as if you are trading into FX, you can consider some FX USD pairs as well. Because the inflation numbers correlate directly with the interest rate movements. And that links to this part, which is the interest rate fluctuations. So we already explained the 3 or more rate cut expected by end of the year. The direct impact we see it is on the US Treasury. So if you invest in US Treasuries directly or through the ETF, through unit trust, it will be of interest to note that when interest rate goes down, the long-term bonds or the long-term treasuries are the one gaining. So they move up because they get more popular, right? Because they're giving you the higher return for a longer term. So if you already position yourself within the treasuries for long term, you might see a better performance of the portfolio as the rates start coming down. Okay. Real estate, banks, and financials. These are the 3 other sectors that on top of the utilities itself that give high dividend. So usually they also direct impact. All right. First thing, they have more demand due to the investment nature. Second thing is that they are directly either benefiting or impacted by the interest rate movement. So for example, real estate interest rate go down, they will definitely earn because they pay less interest, right? There's also more demand for their property. For bank and financials, generally we see that they might earn less because of the lower interest rates means that maybe less of the NIM they can earn, but they can earn more volume. And right now, even after 3 rate cuts or more from the Fed, the US Fed rate is still going to be above 4%. To compare that to Singapore, which is currently our interest rate around 3%, is still higher, even after 3 rate cuts by the US. So you will tell me that interest rate is going to be low by end of the year. No, it's not low. It's just that it's cutting. Right? It's still in a high interest rate environment for the US. So the banks and financial are still benefiting, right? So the real estate and the other counters that are on high debt levels, they are moving up purely on expectations that US Fed will continue their rate cut direction in 2025. Okay, so that's the main direction. So indirect impact, like I mentioned, so tech sector also usually have better movement when the interest rate come down because of the funding cost that they have. The high dividend sectors also will benefit due to the demand into the sector because of the investment fund flow itself. Right. So if your US Treasury give you less interest, of course I need to compensate myself by buying into more high dividend counters in US, then that will be your real estate, utility, and energy, right? As well as the bank sector. These are the four with the highest dividend yield in US. Okay, so trading opportunities. All right, so a few things. FX pairs, you can consider on those different pairs. High dividend counters and sector ETF. All right, so not as a whole, as a general market. If you are not confident of the general market, you don't want to buy in the index that's like S&P 500 or NASDAQ, you can buy into sector ETF that is directly benefiting from interest rate cuts. All right, sector ETF. But do know is that if you are buying the high dividend counters listed in the US, you will be subject to the withholding tax of 30%. So some investors, they tell me, I want to invest for long term. I don't want to pay the 30%. Then you can buy the UK listed, you can buy the Ireland listed ones. Those will be 15%, 15%. So half withholding tax. If you're buying for long term, it's going to be a slightly higher trading cost in terms of commission for compared to US, but you get to save on this long term withholding tax issue, right? So withholding tax is not by us, it's not by Phillips Securities, it's the US government they take. So don't call me in, I want to reduce my withholding tax. Then I cannot call US for you. US don't take up my call. Okay? So next we have a US tech focus, right? So generally for me, I'm still, like we said, tech will benefit. And if you don't know what to choose, don't know which sector to choose, if you're not sure, if you have confidence in the tech sector, the AI push, the AI funding, everything, the long-term direction should not change, right? So no matter what happens in the economy, direction towards AI, generative, your virtual reality, all that should still be intact, right? So tech sector will generally still be on a long-term uptrend. Okay, so if you are preparing for election uncertainty, this is the 5 points I mentioned to you because these are 5 points of contention that will be between Harris and Trump in terms of their policies. So first thing is healthcare. One want to support, one want to reduce, right? So one want to pick up the big health companies. One of them want to support the big companies, right? To allow them to do more price control. So it depends on which national they believe in. But regardless of which whoever win, there will be volatility expected for healthcare sector. First thing. Second thing, if you are invested into sectors with high exports or even imports that is affected by the tariff that maybe Trump want to impose, right? Maybe your tech sector, your automobile sector, and all that. So automobile sector is not only just for China. Even for EU and US, they also have their own issues with the tariffs, right? So your aerospace issue, your defense itself, as well as the EV market, the automobile market. So there's different sectors that are affected by the tariff and how the two different candidates will move ahead after they are elected. You can actually take a look to see. Trump one always don't have a lot of certainty, I would say. He always say one thing, but when he elected, he might do another thing. But the general trend for him is really quite clear. You can see what he have done in the first election. I mean, for when he was first president first time. So his direction is quite stable in the general itself. So he's quite pro-domestic or pro-business per se, but it's negative on the new economy, new energy, which is the new energy versus traditional energy players. Okay. On consumer discretionary itself is more for a correlation with the tariff itself, right? So it might affect. Then the last one is the corporate tax impact on M&E. So at least we know that for Harris, she confirmed what have planned to increase corporate tax. Of course, the plan might or might not be able to push through based on the control over the House versus the Senate. But then that's one impact that you need to prepare for, right? So that's one thing we note, all right? Okay, so for my part, this is the main thing from my part. Next, I'll pass on to Sam, who will be sharing more of the of some of this product called a contract for difference. So when we want to prepare your trading itself, so what we mean? Normally you're only going to do long positions. You're going to buy shares. You're going to buy ETF. But sometimes, like I mentioned, you don't want to just directly sell the holdings. You might want to also hedge positions. So now this one will be able to do hedging for you itself. So I'll pass time to Sam.
Okay, hi everyone. So my name is Sam. I'm from the CFD Central Dealing team. So today, today I'm gonna talk to you a little bit about, share with you about the opportunity that you're missing out, and also what you can grab, the opportunity and how you can prepare for it. Because as you know, change is the only constant in the stock market. Nobody knows 100% what's gonna happen, and how can we prepare, better be prepared for it, regardless of what is the situation, be it it's going up, going down, or even going sideways. And lastly, how you can take advantage of all this to excel and push forward and earn more, and also manage your risk in terms of investments. Okay, so I believe, right, that everyone in this room, right, has an edge over anyone else in this room as well. Why? Because from people here, we have years of experience, be it from our profession, people from different walks of life, different professions, will have different knowledge that even analysts do not know. Most analysts usually read off financial statements, yearly reports, analyst reports. But for us that have been working on the ground, we know the things firsthand. Next, we also have people who keep ourselves updated, like coming to this event, getting the top news and also the most updated news and events that's happening. And also like meeting our friends from different sectors, discussing about economy and how everyone's doing. And because of this, and we have years of experience in the stock market, so we know that how our portfolio react to the news, especially from macroeconomics, interest rates, inflation, and even how our economy is doing. So then, because of this, we usually have a bullish long-term view. Generally, even Warren Buffett always say that, never bet against the US stock market. But in the short run, we can have mixed views. But in the long run, generally that statement holds true. So this is an example. So you can have worked in different industries from F&B, engineers, bankers, Grab drivers, or even marketing. You have information that nobody else will know. For example, there's a saying that how do you know when there's a stock bubble? Is when your Grab driver start telling you about it. So usually, even though we are in different sectors, not in finance, we have unique knowledge. So I have people working at F&B where they will tell me, or they see pickup in tourists visiting their restaurants. Means that the Singapore economy maybe is a bit stronger than what people think. On top of that, let's say you have a doctor friend, so he was able to tell you more about how, certain medicines or breakthrough in biopharmaceutical is helping patients more. And that is something that you can know before it's being reported in the Wall Street Journal. So from this, we can able to detect trends such as a pickup in spending or even slow down in the economy due to new technology or even people from different sectors. And therefore, from there, right, we can actually sometimes have short-term bull or bear views. So, have you ever said it to yourself that I think that my counter is likely to go down due to certain event, be it from your competitors' financial reports or earning releases that shows slowdown in their top line or bottom line. But because as investors, long-term investors, we tend to do not want to sell. So we are usually buy and hold. So when we feel that, there's some weakness or uncertainty, we are worried, but we don't know what we can do about it. Or you have like some conviction that certain companies are the prices are moving too fast, and that most likely it's overpriced because of fundamentals or even technicals. So from there, we will have a general trading idea. So we have a stance that certain counters or certain stocks or even an index itself are more likely to go up or down, or as we say, long or short. And we observe that most investors, me included, are long-only investors. So as a long-only investor, what we want to look out for, or what we can look out for, is we want to identify undervalued or long-term trends, companies or economies with good fundamentals, and we always look out for the positive news, because we only can take advantage of positive news. Next, we will always learn how to buy low and sell high, buy on dips. But however, we are always subjected to volatility. We don't want the markets to go up and down. We generally want markets to go up if you are long only. So technically, we only see half the picture. So as a long-only investor, some of our strategies revolve around dollar cost averaging. We want to have a longer-term horizon. We are very sensitive to negative news, especially when there are like shocks to the market, like in August. One day it dropped 3-4%, and suddenly everyone's a bear. Everyone starts to wonder, hey, are we actually, or is the US actually in a recession? Or, is it overblown? And as a long-only investor, we feel the volatility fully. So let's say you face, as a long-only investor, you face negative news. Usually there's one of three actions that we do. So like, for example, during the COVID-19, March 2020, so you can either do one of these three things, which is sell. But if you sell, the thing about selling is you never know, especially when the markets are in free fall, right? You don't know whether that it will continue falling. Next, you can buy more, which a lot of my friends have been buying more as it goes down. But after a certain point, right, it's like catching a falling knife. So is that actually something you want to do? Or three, you can do nothing. So you just watch your portfolio going in red and more red, and just praying that it will turn up, it will go up sooner or later. So as a long-only investor, during a downturn, it's quite hard to protect your portfolio or even take advantage of it. As it's only one of three things we can do. So however, but if you are able to have the ability to both go long and short, you're able to adjust your exposure, your portfolio with ease to reflect your view. So you can go long and short. So it's not just about speculating in terms of shorting stocks, but as in going long in your stock portfolio, but going short in, let's say, CFD, so that you can reduce your control, your exposure during times of volatility. And when you yourself feel that, there are a lot of uncertainty ahead, and they are more likely or not to go down, or you want to protect your portfolio, especially your gains, then you want to take some money off the table, then you can also go short to have a net lower exposure. So you're able to turn your investment ideas into positions. Because a lot of clients that I hear, especially when they call into our CFD desk, they always tell me, they have a lot of ideas, especially, ideas of certain stock going up or certain stocks are very expensive, indexes. Why keep your investment ideas as ideas when you can turn it into positions so that you can use your edge and also gain an advantage? So being able to take charge of the investment in volatile times is a very important thing so that you can, so you know what you expose and you can control it at all times so that you don't have to worry that every time you wake up, check the market, it's all over the place. Especially nowadays when there's a lot of new events coming up, especially elections, and there are a lot of highly volatile times that might come. So as a long and short investor, we are able to take advantage of both undervalued and also overvalued stocks or counters. Next, we don't only just have to look at long-term trends. We can look at all time horizons, be it short-term, long-term, medium-term as well. Next, we don't only just need to look at good fundamentals. We can look at companies with all kinds of fundamentals, from good to the bad to the worst. Next, we are not only just looking for positive news, we are prepared for all news, be it good or bad. Next, instead of suffering from the dips in the stock market, be able to manage it, controlling our risk so that, in the long run, we do not have so much drawdown. Next, instead of being subjected to volatility, we are able to manage it. So during volatile times, we can actually control our exposure and even make some profits. Lastly, we also have new additional opportunities because if we can do short as well, we actually see the full picture and able to enjoy both sides of the coin. So what kind of new opportunities do you get for being able to long and short? So first, of course, you can always use short positions to hedge your main portfolio. So we generally, for long-term investors, we always have a certain portfolio. Hopefully, it's diversified. If it's not, you can also use CFD to short positions that you have in your main portfolio so that you can reduce your exposure from long 100% down to 0% or even 50% to reflect your view. So let's say you are 50% or 60% or 70% certain that your stock is going to go down, you can actually reduce your position size to reflect that so that if you're right, then you won't feel the full brunt of the drop. But if you're wrong, you still have 30% upside. So it's about controlling your risk. So let's say you own, let's say, 10,000 SIA share, then you can actually use SIA CFD to short to manage your risk, especially when times when, let's say, the competitors are releasing that airlines tickets are, for their holiday season not doing so well. So more likely than not, SIA will follow suit up with their competitors. Then if you feel that SIA has higher probability, then you can actually short SIA to reduce your risk. Next, you can also do plays like you believe that one company will outperform another company. For example, Singtel will outperform StarHub, especially StarHub, their internet score the other day. Then you can long Singtel and short StarHub. So you trade the spread. Next, you can also do some sector plays. So let's say you want to gain exposure or even short certain sectors, especially when sectors are not doing so well. Usually, let's say for now would be, let's say you feel that banks will not do well, then you can short bank sector ETF as a whole. Or if you want to gain additional exposure, you can also use long as well. So why should you use CFD to short? So this is a table of all the different products that allows clients to have a short exposure. So some people may tell me, I want to short the index. Say I think US market is a bit hot. Then I want to short so that, in case it drops, right, I don't feel so much pain. So there are quite a few products from CFD to inverse ETF to DLC and even SBL for stocks. So first, the main difference between all these products is, first is the mechanics. So for CFD and SBL, the mechanic is that you get the difference between the opening and closing price. Whereas inverse ETF and DLCs, what you get is a daily compounded effect. So if you're only shorting for a day, then it is the same. But if you're shorting multiple days, there is a daily compounding effect, which I'll show in the next slide. Next, then there's a lifespan. So of course, you want something that does not have a finite lifespan. You want something that no fixed date, so that even if you're doing a short-term, medium-term, or long-term play, you are not forced to liquidate. Next, you also want something with a higher leverage, so that you can make use of your more effective use of your capital. So you can do more with less. So with CFD, actually, you are able to short with a lot more counters and even have a higher leverage as well. So for CFD versus daily compounding, so your inverse ETFs or even your DLCs, they have a daily compounding effect. So from here, we can see that, so let's say from time 0 to time 7, so in like 7 days, the market dropped from, the underlying dropped from $100 to $80. Of course, stock market, when they drop, right, they don't just drop like a brick. Usually they have a few ups and downs. That's where inverse ETFs or daily compounding effect will really affect your position. So here, you can see that even though the market dropped from 100 to 80, which is a 20% drop, but if you have bought inverse ETFs, you actually only earn $14.53. But if you short CFD, you actually capture the full movement of the $20 drop, and you will earn $20. So if you are trying to short, CFD will accurately able to capture it, so that you're able to hedge your position better. Because if you are long from 100 drop to 80, you lose $20. So short CFD, you will gain back $20. So you are actually net zero. Compared to if you're using inverse ETF to short your position or to sort of cover your position, and you may not enjoy fully the thing there. So next, a famous quote for Warren Buffett would be, the best investment you can make, the investment in yourself, and that the more you learn, the more you earn. So instead of just looking at stocks or equities in general, there are actually a lot more asset classes that is available for investment. Even though usually they have a stereotype of, especially for commodities and FX, usually they have a stereotype that it's high risk, for those high leverage, for those traders, I don't know what's going on, so I shouldn't get involved. But as good investors, we should at least try to understand and learn that there are a lot more opportunities, such as using gold to improve risk versus reward. So gold as an asset, some people may say, it doesn't generate anything, it's just a piece of metal. Why should I have it in my investment portfolio? But gold is actually, throughout history, negatively correlated the stock market. So generally, adding certain amount of gold will actually improve risk versus reward. On top of that, FX actually is used by a lot of investors and traders as a way to earn positive carry. So positive carry is a way that's unique to FX, that you earn swap points every day. So as of 20th August, if you bought the US dollar Japan yen pair, you're actually earning a 0.175% daily return on positive swap, which I will talk more in a while. So using gold as a hedge or negative correlated asset to equity. So it's actually a good use of a hedge against inflation, and is seen as a safe asset, especially a hedge against inflation, and also when central banks print a lot of money. So by adding gold in your portfolio, you actually improve the risk versus reward ratio. I actually wrote an article on this. If you have time, do check it out, because I go into details as into how much gold and why you should add and how do you get buy into gold. So there are multiple ways you buy into gold, from CFD to even some ETFs. So if you have time, you should go check out the article as you go way more into depth, which the time may not allow for today. It will cover how to hedge, strategies using gold, commodities, and even more, even like oil and so on. Next will be foreign exchange can be used for positive carry. So what is positive carry? So when we trade foreign exchange or FX in general, usually we are always traded in a pair, means one currency against another currency. So let's say we use the example of US dollar, Japan yen. So when we buy this counter, we buy this currency pair, we actually buy US dollar and we are borrowing Japan yen. So every FX transaction, there will be one that we buy and another one that we sell. So when we sell or when we borrow, we have to pay the interest. But when we buy, we receive the interest. So for US dollar, Japan yen, if we buy this, we are buying the US dollar. So we're receiving US interest. But we are borrowing yen, which means we need to pay US dollar, Japan yen interest, which is known to be very low. Currently, it is about 0 to 0.25%. Then because of this difference, there will be a positive interest rate gain every day. And because FX has one of the highest leverage in 20 times, then let's say currently there's a 5% interest rate differential, but usually the broker will give you 4, roughly 4 times 20, that's 80% here. 80% divided by 365, that's about 0.175, 0.18% a day. So these are the positive carry that a lot of traders have been enjoying and using. On top of that, you can actually use FX to hedge your currency risk. So a show of hand, who here bought any US stocks or foreign stocks? So quite a few. So if you bought US stocks, right, you're actually exposed to US currency risk. If US currency devalues, then when you convert your profits back to Singapore dollars, they become a lot less. You may actually lose money in Singapore dollar terms, even though you make a profit in US dollar terms. Because when you bought that time, let's say Singapore dollar, US dollar is very strong. So you use a lot of Singapore dollar to buy this position. But when you decide to sell, the US dollar has fallen, then you actually may have lost money, even though you made US dollar, but you lost Singapore dollar instead. So to hedge this risk, you can actually use FX to hedge it. So let's say you are in the US market, then you can actually short the US dollar Sing. Means you short US dollar and you long Sing. So even if the US dollar drops, this position will earn you profits, even though US dollar have dropped. Because you short, you make money, and it will protect your US dollar profits so that you can focus on what you're good at, which is trading or earning money in the US stock market, instead of trying to speculate on two things, which is your position must make money, and also the US dollar must still remain strong, so that when you convert back, you can get your profits in Sing. But lastly, FX can be used as speculation as well, especially US dollar Japan is a very good example. When you reach 160, people start to short the US dollar and long yen. So now, for CFD, we also have something called leverage or margin and leverage. So to me, leverage will both improve your returns and also your losses. But however, I see it differently. So leverage to me is the ability to do more with less. I always like to compare leverage like an F1 Formula car. If you give an F1 Formula car to a new driver, right, they are more likely to crash. But if you have a professional driver with the proper knowledge, discipline, and skills, they are able to take advantage of the car, or for this leverage, to able to use it for what it was designed for and really push it to its limit. So leverage actually, with the proper risk management, is an advantage that CFD as a product offers. Of course, you must have proper discipline, risk management, and so on. If you feel that you use it more for like you see it as more as like gambling or increasing your stakes, then I do not advise using it. And leverage also able to allow you to have access to harder access market, especially when the nominal value is a bit higher. So let's say you try out trading the Dow Jones, then one contract value is like 30,000-40,000. Then of course it's a bit hard to trade size if your one trade size is 30K. Oh, but with leverage, then your trade size is a lot smaller. Then you're able to actually average in and actually do more trading instead. So in conclusion, CFD, you're able to hedge your position with ease from just pressing sell, no borrowing, no all these troubles involved. You're able to manage your risk however you want. So anytime you want to manage your risk, you can do it because CFD is traded 24/5. You can turn any of your trading ideas into positions. So you don't always have to say, oh, I think it's the market very expensive. Because you are long only, you can't take advantage of this information. But now that you are long and short investor, then you can take advantage of it. Next, you can also diversify in different asset class, like index, FX, commodities. And then you have the ability to do more with less, with leverage. And that CFD is a OTC and it's a derivative. So if you plan to trade CFD, you need to do the CKA, which is a test mandated by MAS. And lastly, you are prepared and ready for all opportunities. Because usually I advise clients, you may not want to trade CFD now, or may not want to even consider CFD right now. But you should be ready that when the time comes when you want short or reduce your exposure, you have it ready. So that you're not caught surprised, especially when the markets are going up and down. You want to sleep well at night. Sometimes you will want to have a net and hedge off your risk. So for now, actually we have this promo. If you have created for today and until 30th August, if you have if you don't have a CFD account on an NRC level and you decided to open one with us this month, so, you just by opening a CFD account, you will actually get a Palantir CFD for free. So it's just free position, free money. Then next, when you open, you decide to trade up to 1.5 million in contract value, you will get a TSMC CFD. And then if it's about $160. Then if you decided to trade even more, 4.5 mil, then you will get a Microsoft CFD. For people who see, wow, 1.5 mil, that's a lot. Actually, if you trade it, because CFD, we have counters that are commission free, no comp. And some of our contract value can be quite big. Actually, 1.5 mil is quite achievable. We have clients achieving it in 3 days, a week. So it's actually so this promo actually ends in 30th August. So you have about a week. So if you want, even if you cannot reach the second or third one, you just open an account today with us and make sure it's your first account, then you actually get the Palantir, the first tier, Palantir CFD. On top of that, today's special, no matter whether it's your first account, but if you opt in for CFD or MT5, you will actually have a $10 Starbucks gift voucher for you that we have behind. So later you can come to us and show us that you opt in, then we will pass you the $10 Starbucks gift voucher. Yep. Okay, thank you very much.
All right, thank you, Sam. So now we'll be moving to the Q&A session. So anyone from here have any questions to check with us? Which military counter? Okay. So I think for those that have questions on the floor, also do feel free to raise your hand. We can address your questions. We have a Q&A segment right now. For the one that is asked online, right? So for defense sector, all right, I think the two main ones that we normally know, one of them will be the Lockheed Martin. The one is I think most people currently should be aware of. In general, they are quite sensitive to the news, but I think the issue is that the conflict-wise has not been developing much. So US have been increasing their aid to especially the Ukraine side. So they have always been declaring that they have increased aid, they'll be giving more weapon supply and everything. But you're asking on actual benefits to the stock counter, I think it's a bit more minute now, especially with the US election coming up. Because in general, I think you can see that for Trump's side, he has usually he will increase spending. But for Harry's side, she might actually the Democratic side might actually control or restrict spending in the military budget itself. So the direction of the counter for investment for military or for the defense stocks so called, I would say for now for 2024 at least, we should look at the elections results more than the conflict directly. Yeah, because the budget is the one that going to affect the counters more directly. Right? Any other questions that we have? Anyone got questions for myself or Sam? Yeah. Yeah.
No, no, no. No, for all counters. So you can trade any counter. So for this one, it means that you get this for free into your CFD account. So
That
we
is the
will
free
award you that's a free gift. What? Yep.
Yeah.
One contract.
The one share for free is already 160 USD for TSMC. So the 1.5 million is a traded value. So when you open, you must close. So when you trade 1.5 million, technically you're only trading 750,000. Once you open 750,000, you will sell 750,000. Or you will sell first and buy back. Same thing. So the 1.5 million is the total traded value. So it's inclusive of opening and closing. So not asking you to buy 1.5 million straight and then sell 1.5 million. No. It's you can trade, let's say today 300K total trade value. So you trade 300K, you buy sell is 600K already. Then 3 days you hit already. Yeah, then you can get this. But the ones that hit this volume faster, like what Sam mentioned, for the
Unfortunately, this promo, if you are existing CFD account, not
but if you are existing but you have friends or family members that have not yet tried, you can guide them. You refer them to open account, you get the referral fee, then they can get the award lah. You can get the new account award, then you get referral fee. Yeah, if they have no account with Philips yet. Yeah. Any other questions regarding the promotion, regarding trading CFD, regarding US market, anything you want to ask? Any interest? Questions? All right. So confirm no questions. All right. If there's no questions, we'll end the Q&A. All right. So we'll thank everyone for joining the online session, especially. Thanks for anyone. If you have any questions, you will too shy to ask now. You can ask us later at the back, or you can ask us through email. All right. So